The USA has a massive debt problem, and its proportions are so large that it could completely change the way you and your kids will live in the future. Hello everyone, and welcome back to The Good, The Bad and The Bitcoin. Today we are diving deep into a topic that affects us all, the US debt situation. From national debt spiraling to baffling heights since 2008 to the recent surge in mortgage rates, we are breaking down what it means for us as individuals and for the economy at large. So let's get started. The development of the US national debt from 2008 to 2023 can be understood in several phases, each influenced by various economic factors, government policies, and global events. 2008, the national debt stood at about 10 trillion US dollars at the beginning of the 2008 fiscal year. This was just before the financial crisis hit its peak. 2009 to 2012. In response to the financial crisis, the US government implemented various stimulus measures leading to significant increases in the national debt. By the end of 2012, the debt had risen to approximately 16 trillion US dollars. 2013 to 2016. The debt continued to grow during this period, but at a slower rate. By the end of 2016, it was near 20 trillion US dollars. 2017 to 2020. The Tax Cuts and Jobs Act of 2017 and increased spending contributed to further debt growth. By the end of 2020, the debt had surged to around 27 trillion US dollars. 2020 to 2023. The pandemic necessitated substantial fiscal spending for relief efforts. By early 2023, the national debt had exceeded 30 trillion US dollars. In economic terms, accumulating debt at a large scale is actually not so much a problem if the income, for example through taxes, of a country is either also growing or is already enough to pay off the debt again. This is often measured through the so-called debt to GDP ratio. The debt to GDP ratio is a metric that compares a country's public debt to its gross domestic product, GDP. By comparing what a country owes to what it produces, this ratio provides an indication of a country's ability to pay back its debt. And here things get a little bit more concerning for the USA, because the debt to GDP ratio of the USA has actually almost doubled from 73.2% in 2008 to approximately 140.6% in 2023, while the GDP only grew about 65% from 14.72 to 26.24 trillion US dollars. Now, I don't know, but if I were to tell you that I have this great plan to double my debt within the next 15 years while only generating 65% more income, you would probably, rightfully so, start to question my sanity, right? Of course, we cannot compare the financial decisions of an individual household to those of countries, because very often investment of countries are designed to not generate revenue in the form of taxes immediately, but in the long run, such as investments into infrastructure, change of regulations, education, and so on and so forth. A good example of a country planning its development of infrastructure long-term ahead is Singapore, which uses so-called concept plans, which are comprehensive long-term plans looking 40 or 50 years into the future. They're reviewed every 10 years to ensure they remain relevant and responsive to changes in trends and circumstances. As long as a country grows and the interest rate payments for its debt do not eat up too much of its GDP, there's no immediate danger of a collapse. In the case of the USA, interest rate payments in percentage of its GDP have remained rather stable, from 1.71% in 2008 to 1.84% in 2022. So nothing to worry about, right? The effects of all the stimulus packages and general increase in debt are not a problem, and the USA is eventually going to catch up again growth-wise, right? Well, sadly, probably not. The problem is that most of the US debt is still financed at rather low interest rates. According to Forbes magazine, the average interest rate on national debt is at 2.97%, with 50% of the debt maturing within the next 3 years. Since the Fed raised interest rates to, at the moment, 5.25% over the course of the last 15 months, this debt will need to be refinanced for likely over 5% in interest rates, leading to a massive increase of a percentage amount of interest rate payments that eat up the US GDP. With the US GDP only forecasted to grow by 2.1% in 2023 and 0.9% in 2024, according to Swiss Re, large portions of the GDP growth would already be eaten up just by the increase of annual interest rate payments for the US debt. Just to maintain the status quo and without wanting to accumulate even more debt, which, let's be realistic here, will probably take place if the USA does want to avoid government shutdowns in the future. It is kind of the same problem that many US households face at the moment that want to buy a house or an apartment. The average price for a house in the USA is around $430,000. In January 2022, a 30-year fixed mortgage rate was still available for around 3.22%, costing the home buyer around $1,150 per month in interest rate payments. In November 2023, the same 30-year fixed mortgage rate was available for about 7.5%, more than doubling the monthly interest rate payments to $2,690, which leads to buying homes being impossible for most US households. At a larger scale, this is the exact problem the USA is facing. 50% of the existing debt will need to be refinanced at much higher rates, a situation that could quickly spiral out of control if the US government does not implement strategies to lower the debt to GDP ratio to more moderate levels again. I actually asked ChatGPT how the US debt problem could be resolved, and this is what it had to say about it. Spending cuts, entitlement reforms, bipartisan cooperation, tax reforms. These are all things that of course make absolute sense, but the question is whether or not they are realistic to be taken on by politicians that want to get re-elected every 4 years and are hesitant to implement solutions that might benefit the country long term but hurt the average citizen short term. In my personal opinion, the solution to this problem will be what it always has been: more money printing and hoping that through some innovation or miracle, somehow the problem is going to resolve itself. So do not be surprised that despite an ongoing growing debt to GDP ratio of maybe 180 or 200% in the near future, the financial markets will not crash due to the Fed lowering the interest rate environment again to under 2% and freshly printed money flooding the stock markets. How long will this be sustainable? Nobody really knows. In my opinion, it is, however, important to at least have some savings in instruments that are not losing their buying power over the course of time. For me, the best instrument to do so is, despite its volatility, Bitcoin. If you enjoyed watching this video, please leave me a like and subscribe to my channel. I publish new videos about trading, investing, and the economy every week. Until we see each other again, happy investing.